What if your landscaping business is growing, but you're actually destroying value while you do it? Today, we are cutting through the noise about exits, valuations, and having a conversation that every green industry business owner needs to hear, whether you're looking to sell your business or not. I'm Chad Diller from Landscape Leadership, and my guest today is Jeff Harkness from 3PG Advisors. Jeff has helped some of the top companies in the lawn and landscape industry scale smarter. They become more profitable. They build brands that are ultimately worth more money. And in this episode, we're digging into the 5 pillars that truly drive enterprise value, the marketing mistakes that kill deals before they even start, and systems that separate valuable businesses from broken ones. Stick around because this might change how you lead your company. Well, ladies and gentlemen, I have a really special guest for you today. We are with Jeff Harkness from the 3PG Group. Jeff, thanks so much for joining us on the podcast today. Good to see you again.
Yeah, Chad, thanks for having me. Great to be together.
Yeah, so before we jump into today's topic, we're going to be talking about creating a valuable company. And before we jump into that, why don't you give our audience a little bit of background? Tell them, who is Jeff? What's 3PG? What do you do for the green industry?
Yeah, happy to. So we're down here in Atlanta, Georgia, and we are a advisory firm that's really focused on the mergers and acquisitions part of the industry. My background, and people ask me all the time, why do you like to work with green industry, landscapers, tree care, turf care folks? I grew up on a dairy farm in upstate New York. And so I've always been a blue collar kid and just love the people and the work ethic that you and I come across every day. When I moved to Atlanta, I was fortunate enough to go to work for a big financial planning company that had a mergers and acquisitions shop in the basement. And every Friday as a newbie, right? I was one of those young kids, newbies. The senior partner taught a target marketing class that was built around being successful in the world of M&A, finance, anything in that accounting type of world. And what Tom taught us was you need to have a specialty niche. You need to be somebody that knows all the magazines, all the software, all the advisors, all the different folks that impact a specific vertical. And so I was fortunate early on in my career to learn and build a business model that 30 years later with 3PG Advisors, we're still executing. And I built that model with some really great people that were influential in my life when I was 23 years old. Fast forward today, we have an 11-person team. And Chad, the deal business used to be just me getting 2 landscapers together and we can, make a deal. And now, given the amount of institutional private equity money, it's become very diligence driven.
Sure.
Everything from business to accounting and finance. And so, like I said, 11-person team. We got a lot of accountants and CPAs and an attorney on staff, and super proud of our team. We've been really active. We've done over $1 billion in transactions and did 14 deals last year. But what's exciting, and you and I talk about this all the time, is we're just working with great companies and great people, helping them grow and scale a business. And it's been a fun ride, to say the least.
Yeah, so you've been through this, a bunch of reps with different landscape lawn care companies within our industry. And I'm sure you've worked with, medium to large companies, different sizes. Why do you think, I would assume that there are a lot of companies that you're coming across that maybe you don't get to the deal table with that aren't really building a valuable company? And why do you think so many leaders and company owners wait too long to actually focus on building value in their companies?
Yeah, it's a great question. Let's take a step back, because you and I have been in this long enough. A lot of the industry prior to all the institutional money was a real simple premise, Chad. It was one customer at a time, one employee at a time. And over the next 40 years of our professional career, we're going to build a business. And and there's nothing wrong with that, by the way. You and I've come across many great families and companies that have built it that way. But when you're building it one customer at a time, one employee at a time, your ability to grow and scale is dependent on, in my opinion, two things. One is your risk tolerance, and two is your access to capital. And in the world of essential services companies, your access to capital a lot of times is dependent on your personal financial statement. Hey, Chad, how much real estate do you own? How much cash do you have? What are your assets that if you and I wanted to go out and buy a small turf care company, a traditional bank or senior lender would say, hey, Chad, I'm going to check your credit. I'm going to make you prove to me that you can cash flow your existing debt and this new debt that you're asking for. And last but not least, if the loan ever goes bad, I want to make sure I can come take stuff like your house, trucks and equipment, right? And so the limiting factor in the industry was always risk tolerance and capital. Now you enter this world of private equity money. If you understand the private equity model, they raise millions and millions of dollars, and then they have to go deploy that. And so, when you look at an entrepreneur today, there's not a right or wrong business model. The question becomes, where do you want to go and how do you want to scale? And if you're going to scale, you have to solve for the capital side of things. And the more that you can solve for the capital side of the equation and then get into building sustainability in your revenue, that, Chad, how many times have you heard that reoccurring revenue, right? Yep. You've heard that term all the time.
What they're after.
Yeah, that's one of the value creation drivers on what makes a turf care company that does fertilization and weed control more valuable or more marketable than a landscape construction bid build design build firm. So
I think, before we kind of get into what are these drivers that drive value into companies, I want to kind of address our audience a little bit and maybe kind of kick it back to you a little bit too. I'm sure there's some people that, they saw the title of this episode and they were like, yeah, I want to sell my business someday. But there are those that are maybe a little curious and just trying to be informed that might say things like, I'm never going to sell my business. So how would you respond to someone that would say, I'm never going to sell?
Yeah, I think it starts with what your goals are. And one of the goals that I think as an entrepreneur you need to think about is as you get later in your career and your risk tolerance becomes less and you accumulate assets, right? So you're worried about, hey, I never worried when I didn't have any assets. Now that I have assets, I'm worried about people coming after me. You just need to step back and solve for where you want to go as you scale a business. And if it is a handoff to employees or a handoff or succession plan to family, there's nothing wrong with that. But now we're in an industry that you can still scale and along the way take a lot of chips off the table that, create opportunities with cash and wealth that the average entrepreneur might have stuck in trucks and equipment or real estate. So I look at opportunity and say, well, where do you want to go? And this will sound corny, but I like to solve for the three-legged stool. How much money is enough? What do you want your time commitment to be like? That's the second leg. So the first leg is how much is enough? And everybody's got a different number. The second leg of the stool is where do you want to spend your time? And then third is kind of what's your sense of purpose? And so if you use that three-legged stool concept, it's not about building a sellable business and it's not about gosh, you got to sell to private equity or transition to a family. I think each of us has to look in the mirror and just say, what's important to me when it comes to my purpose? How much money's enough? And where do I want to spend time and what do I enjoy doing? Believe it or not, you and I see examples of that every day in business. And again, it's not about, to your point, hurry up and sell.
Yeah, I think value, whether you're going to sell or not, like you said, it opens up the world of opportunity. Like the options are there. If you don't have a valuable company, there's certain things you just can't do. And if that's passing it on or creating, better careers and sustainable future for your workforce, you can't do that because you're struggling. You're dealing with all these things. What about, there's this one thing that I see constantly in the industry, and I don't think we're ever going to get away with it, but the vanity metric of revenue. I mean, it doesn't equate to a high value company with that top line. I mean, what would you have to say to address kind of like this? I don't know. Are we ever going to be away from this fixation on how much do you guys do in revenue?
Yeah.
Are we always going to be, is that going to be the conversation opener other than where are you guys located at? I mean, I feel like those are the two questions that everybody has at networking events. Are we ever going to be away from that? Do you feel like the tide shifting of people understanding that doesn't equate to value?
I think in that turf care, fertilization, and weed control, there's a lot of folks that talk about values based on some multiple of revenue. And maybe there's some truth to that. But at the end of the day, I believe you can throw out all these financial metrics and focus on two things. One is gross profit margin in dollar, and second is cash flow. If I'm evaluating a business and I got a bunch of really smart accountants and auditors and MBAs around me, I don't need 50 metrics. Regardless of the sales volume, Chad, I can look at gross profit margin in dollars, and I can do a cash flow analysis and step back and say, this is an exceptional company. It's worth more or it's worth less.
Yeah. And when you guys look at multiple things, so those are two big things. You're looking at cash flow, you're looking at gross profit. But I know you've personally said there's like these 5 big things that you typically look for when you're creating a valuation of a company. Can you share with our audience like what those are and give us some explanation behind those? How do those drive the overall value of a company?
Yeah, the first is, let's just you and I put an investor hat on. So I'm taking off my visionary hat, my operator hat, my accounting and finance hat, my administrative hat, whatever. I just got an investor hat on. And let's say you and I got $2 million that we want to invest, and we're trying to decide between putting in a fencing company, a roofing company, a maintenance company, a turf care company, a tree company, right? But you and I are investors. We want a return on our money. So if you and I put $2 million in at the end of 4, 5, 6 years, you and I would like $6 million back. Okay. Here's what drives that. The first is, as an investor, I'm going to make decisions on people. I want to invest in leaders and people that I know, one, drive an ethical business, but two, have a track record of performance and people, right? You've heard this all the time. It's a people world. But that's the first driver. And remember, a lot of times the audience forgets, you don't just wake up one day and be a great leader. I mean, it is a learned skill. Mm-hmm. And thankfully the industry, does a really good job with that. So the first value creation driver is I got to pick the right leadership team and people, right? That's first. Second is I want to make sure that there is a track record of reoccurring revenue. I don't want to start at zero every single January 1 and have to go out and resell everything. So whether it's elevator maintenance, whether it's turf care, tree care, maintenance, irrigation, repair, lighting, one of the fundamentals to value creation, that it is a true service-based business with reoccurring contracts, right? And so that drives value. Third would be, and this is a big one, and we see this in the industry, Chad, is you can't have money come in from a bank or an investor if your books are wrong. If you don't have good compliance around your accounting practices that you can measure and report, that you can stand up to. You look at this Trump administration with all the things happening with immigration, you have to run a compliant business, right? So financial metrics, compliance reporting is really big, right? So that becomes the third. The fourth would be, I'm in a market, a service, and with a leadership team that I can grow and scale. You and I don't want to invest our $2 million and go backwards in profit and cash flow and revenue. And typically, if we're going to invest in a business, we want to 3, 4, 5x the business. And so we need an industry and a market and a leadership team to be able to do that. So it's very growth minded. A lot of people that think they want to sell their business, they tell too much of a story of historically where you've been or where the business been. They're not forward looking in their narrative to say, hey, if I'm at 5 million today, here's how I go to 20, or if I'm at 20, here's how I go to 100. Okay. And then kind of that last value driver, in my opinion, is there's an opportunity to insert technology. There's an opportunity to insert training and leadership. In other words, if you and I are investors, we don't want to, there's runway. We don't want to invest in a company that's peaking. We want to invest in a company that with our investment and with our tools, we think we can take to the next level. And so I tell people all the time, hey, there's runway, there's opportunity here versus, hey, I'm at peak performance. And with size and scale, I likely go backwards in some of the margins and some of the financial metrics because I just haven't invested back in the business. So those are good examples of kind of those key value drivers if we're growing a company together.
Yeah, it's all about people and having those processes, being able to prove that track record. And one of the things that I see often is we have a really strong visionary. Maybe they're very financially literate. They're very good at of keeping people accountable, building out systems. And you have this leader that's running the company. And maybe during the acquisition, they're part of the deal is they have to stay on for a certain period of time. But really, when you look at the company, like one of the big drivers of the reasons it's succeeding is because it has such a powerful leader at the helm. But when you have an exit like that, you have to be able to prove that your people have already been empowered and have already been stepping up into that. And you've been kind of fading back and inspiring them. Or else, that's going to be pretty volatile to buy a company if it looks like things are going to fall apart after that transaction happens and that person leaves, right?
Yeah, totally agree. I use, the new movies coming out, right? This Superman mentality. It's scary if you and I are investors where we got this one hyper type A dominant owner that's exceptional, and then there's no depth to the bench. There's no process and system. And a lot of times, Chad, on deals when we're doing buy-side stuff, the biggest underwriting requirement that I have in due diligence is what do I do with the owner? What are that owner's goals? Is that owner going to be a problem? Is there a number two that sometimes we step in and it's like, there's excitement and relief from that team because the owner's been holding back that company from growing because the owner's been a bottleneck, right? And in fairness, there's times where that owner becomes exceptional, with a new partner in a model, but it's a key underwriting component. And what's great about our industry is we see a lot of different personalities and people at the top, and it gets fun to kind of figure out that puzzle.
Yeah. So I'm going to bring it back to kind of the core thing that we always talk about here on the Landscape Leadership Podcast. And I'm going to talk about marketing and branding a little bit. You and I have talked before in person a lot about this. You're saying like a valuable company is one that can prove that it's going to have opportunities for recurring revenue over and over. What kind of role does marketing play? Like when you have investors that are looking to acquire a company, or if you're like, hey, I'm not going to sell my company, but I do want to truly build something valuable. how much weight does marketing and branding carry with the valuation or the value of your company?
At the end of the day, the marketing, business development, sales team becomes the key driver of organic growth, net organic growth, right? So we know that in our world, some customers come and go, but, we're really looking for the relationship between that sales and business development team and what's happening from a marketing side, from a digital, social media, AI, any of those. But that underlying key metric is organic growth, and investors like to see organic growth in the high single digits to low double digits. And that's after your losses, as an organization. So I'll give you an example. If my retention is, let's say in the landscape maintenance world, it's 90%. Well, if I want to grow by a net 10, that means my sales team, business development, and my underlying marketing program, I really got to grow by 20% gross to be able to net 10%. And what we see constantly in the industry is not a big enough investment in the front end. We got operators that don't work with firms like yours and make the kind of investment that they need in marketing and in business development. We see groups that don't really have sales teams. How do you get leads? Well, they saw my trucks. We get referrals. And in this day of digital and AI, that's the old model, Chad. And so we see big time investments and a big time need to drive organic growth with the kind of things that you do every day in that marketing and business development world. And it's kind of blown up over the last 5-6 years, candidly.
Yeah, I have conversations all the time. Like I just talked to a company in Colorado the other week, $15 million company. Hey, we haven't really spent any money on marketing, but we've kind of had a little bit flatline, very like 1 or 2% growth in the last couple of years. We realize now this has only taken us so far. And for us to grow more, we need to do something different. We need to diversify how we're getting leads to our business. So now we're talking about that. I have a theory, and maybe Jeff, you can check my theory. You can tell me if this actually, when you get to the deal table or evaluating a company, if this makes any difference. And my theory is that you would talk about people. So the more proof you can show for how people are going to be integrated into your company and your customer base through your marketing, the more marketable your company is, the more sellable your company is. So for example, if you're going company A, they haven't updated their website in 5 years, they do very little, they put a lot of little content, they do whatever. And then you have company B, and company B, it has, they're showing all their team members, you see videos, photos, articles, all those things about career growth, the projection of people, the people getting promoted through the ranks, stepping to leadership positions. You also see case studies about the relationships, the processes that they employ to get a prospect to a customer and to ensure customer success. And you can see that as a buyer, you're seeing that there's less mystery, I would think. And I think you could my theory is you could demand a higher multiple by being able to say, we're not just claiming this, I'm showing you proof of this. Mm-hmm. So that's why I believe marketing, if you want to create a valuable company for you to keep, is important. But also if you want to sell someday, it's also important because you have to be able to substantiate your claims. Would you agree with that?
Yeah, 100%. And you're right on point. The big metric in the investor world is organic growth, and we're still in the industries that you and I run in. It's still undervalued in the eyes of the entrepreneur. It's valued at a high level from the investor community, particularly to the point where it's like, hey, we know we need to insert those different programs and opportunities. And, in my world, that turns into 1 to 2 turns in the multiple. because we have a business that's got a track record of organic growth, and it's got systems and processes that are leading edge around the marketing, business development, digital AI world, and that creates more value 100%.
Well, and there's a part of this too that, like, when you're looking at a company as an investor, I don't know how to say it, like, this potential company to acquire could look sexier than the other ones in the marketplace. You know, like, they're hip, they've been putting out great content, they have a wonderful image. You can tell that they've been putting in the work year after year after year to get that image out there in the marketplace, versus someone that, like, you're not. There's 3 other companies like that, and you're not that person. So It's going to influence your valuation and just your overall sellability of that business. It's probably going to make your work a lot harder to get that deal to close.
Yeah, it's a better company. Over the last 10 years, as technology has continued to evolve, it's become very much a required check the box on what's an A company, a B company, a C company, and we got a front row seat every day of when an investor or buyer says, "Well, why are you asking me to pay more?" Well, let me point to these executable items that are on the front end of the business that, by the way, Chad, they drive growth, but they also drive retention, and they also drive workforce to come work for you. And I think driving retention and driving potential new employees to come work for your organization, when you're best in class on the front end with everything that we're discussing on the digital and marketing side, it's not just one lever, it's really 3 levers. Yeah, it's organic growth, but it's also recruiting from an employee perspective, and it's also customer retention. 3 big check the box items. To go back to your simple question, does it drive value? 100%. And it separates yourself from the competition. Remember, and I say this respectfully, how do you get leads? People see my trucks and we get referrals. Yeah. It's just not good enough, right? It's not good enough anymore for that best in class. Yeah.
Yeah. So sidebar on this. So I've had some experience, with some wonderful clients that, made some exits and were acquired by PE firms and that sort of thing. And one thing that I noticed, and I'm curious, what would your recommendation be to a potential buyer that acquires a company when it comes to this topic? One thing I've noticed is they look right away at, so we'll have an engagement and it'll be, website development. Website's already up, but there's further like enhancements and things we want to do, content creation, video production, photography, that sort of thing. And then there's ad campaigns. What I've noticed is that the default attitude, there's exceptions to this, is, hey, let's cut anything that isn't going to drive activity immediately. Like, we'll keep these ad campaigns, but we have no interest in creating video, because that is something that will work, but it's probably going to be a trickle effect over the next 4, 5, 6, 7 years, or a larger website project or those types of things. And of course, I'm a little biased. I'm kind of like, those things are very, very important. But I feel like, what you're talking about here is if all these things create value, why should a buyer maybe have some pause before they say, you know what, let's just focus on what's going to happen this next year and let's cut some expenses? I mean, would you recommend that for a buyer as they take on a marketing company that's maybe existing in a relationship with a company?
Yeah, I don't know that I see that. I get what you're saying. I think there are some myths and stereotypes on cutting expenses. I would look at it this way, not to get too deep in the numbers, but investors, the value of the business is driven by cash flow and EBITDA, which is a profit loss statement entry, right? So when you and I go into the P&L and we look at sales and marketing expense and there's cost, in theory, if I can remove some of that cost from the P&L, it's going to increase my profitability. But at what expense on the revenue side? The other thing that's interesting, and don't hold me to this because it's too new, but the new bill that Congress and Trump just signed, there's a lot of verbiage in there around R&D, research and development. If we could figure out from an accounting perspective a way to take some expenses off the P&L and capitalize them to the balance sheet and write that cost over time, that's kind of killing two birds with one stone. That gets interesting. I think on the sales and marketing, just to close the thought, we often look at customer spend over a 5-year time horizon. And if I'm looking at customer spend over a 5-year time horizon, in other words, if I'm in the tree care business and I'm looking at all of my customers over a 5-year time period, I want to kind of see that customer spend is increasing. When you start pairing that with your marketing expense, and is there some correlation there of the investment that you're making in marketing and sales and business development with customer retention, customer spend? Remember, sometimes you got to dig deeper in some of the metrics to prove a point. And I'm a big fan of the revenue side of the house. I think we get a bad rap in the investor world sometimes that they just want to come in and cut expense.
Yeah. All right. Well, maybe I've been through some bad experiences through there where I've seen that slashed pretty darn hard. So, all right. Well, let's.
You got to call me, man. I got to beat those people up, right?
You can beat them up for me. Yeah, I think that's a good point because I tell people we'll go to like a renewal engagement. Maybe we did a website for them 5-6 years ago, and now it's time to do it again because it's like the fashions my kids tease me about. Shouldn't be wearing this anymore, and it's time to update things, keep them looking fresh or whatever. And we'll say, well, yeah, that's a big chunk for a new website this next year, but really, I'm not going to come back to you on this for 5 or 6 years. So however you need to do it with your accounting, maybe spread that across 5 or 6 years or do it in your brain that way. Same thing with video. And I think the bigger question, like you said, you have to dig into the numbers. The bigger question I would say, if you're looking at purchasing a company is, okay, but where are those marketing dollars being spent? And like, how are they being utilized? It's one thing when you dump a lot of money in for an ad campaign and you have a short run where it comes out at the end. It's another thing when you're like creating these investments and you're using them over and over. They're being used on social media multiple times. They're used on multiple pages on the website. They're being used in the sales process as you're sending digital information back and forth, and it has a deeper story. So anyway, that's enough about marketing. I don't want to take over the topic here a little bit, but I'm pretty passionate about that. Let's talk about what are some things that, like as you look at the industry now, like just a couple of things that you wish that company owners would stop doing, and what would you want them to do instead?
Yeah, I'm going to use a commercial versus residential scenario. Okay. I think the residential services world is way out in front of the commercial world when it comes to customer acquisition. If you look at some of the HVAC companies that have scaled, if you look at residential plumbing, electrical, the world that we live in now, the consumer, in my opinion, both at the residential and commercial level, they're living on their phones. And so being able to get in front of that potential customer with approaches that are different than just relationship selling really allows a company to separate themselves, even to the level of, like in my world, going in and mining LinkedIn, and figuring out who we need to talk to. And there's a real simple premise that sometimes gets overlooked, Chad, and it's this: we're not going to wait for you to come bang on our door to do business. Like, we need to get out there and we need to be banging on doors and asking prospects and folks to do business with us. And for whatever reason in the trades, I still feel like we're way behind in that. And again, I think commercial's probably a little bit behind, still more relationship selling versus what we're seeing in the residential space around that digital, component. And then I've mentioned this 3 or 4 times. AI is just fascinating. Like, where's AI going to take us when it comes to opportunities, with customer acquisitions just based on what we can do with AI, if that makes sense.
Yeah. Good stuff. So just give us a couple, like if anybody's going to listen to this episode and have a couple big takeaways, what's 2 or 3 things that they should remember and not forget?
I think number one is you need a plan. And too many times we still see companies that they don't even have a budget, Chad, let alone a budget for marketing and business development expenses or understanding EBITDA. So we're a big believer that if you're going to grow and scale, it takes planning and man hours, and there is a formula and a playbook to do that. The industry's not getting any easier, but we still run into prospects that they just don't plan enough, right? I'm just out there making the donuts and doing everything I can to keep my head above water. So we're big believers in strategic planning. We're big believers in looking at a 1, 3, 5 year strategic plan. And within that strategic planning, I like to engage leadership teams, and I like to educate them on a scaling up strategy. And as we talked about today, that can be across the concept of scaling up applies to multiple areas of your business. And so that's really important. And that does take an investment, right? With your group, with my group, whoever. I think that's the biggest lesson. I think the best companies don't wing it. And we like to be very intentional in creating value and intentional in scaling. And too many folks, I think, still aren't, it's not resonating, unfortunately, with some folks.
Okay. What's a closing question? What's a hill that you will die on when it comes to creating value with your company?
Ooh, that's a good one. I would say this. I'm really passionate about the concept of legacy. I'm really passionate about the term transformational. And I'll close with just a 2-second story. I sat in a conference room one time with an owner that I had a lot of respect for, still do today, and he's barely 40 years old. And we worked intentionally to grow the business, and we had an investor in. We're sitting with the 4 leaders in the room, and the first thing he did is he said thank you, and he slid checks around to all 4 of the people in the room, and they opened it up, and it was a $175,000 check. One
Wow.
person sitting in that room was ex-Marine. He could kill us 10 different ways, just a bad man, right, in a good way, served our country. And I can see him get emotional. And he steps out to call his wife. He steps out to call his parents, comes back in. And then I step up and say, by the way, in addition to the thank you, we're making all 4 of you in the room owners in the business with us. And we're going to go grow this company to $100 million. And oh, by the way, you 4 are now owners. And your ownership interest, if we execute this plan over the next 5 years, okay, it's going to be worth $1 million or more to each of you. You think anybody's leaving that company?
No.
Nope. So die on a hill for me is you can't do it alone. And I've had a front row seat of having a transformational legacy impact on the people that are most important to you in your business, right? And the good news is we're an industry where that's happening every day. But sometimes people just don't believe it. I'm here to tell you it's real.
Yeah, the generosity that can transform not one person's life, but maybe a generation or 2 in their family. That's amazing. That's a great thing to think about. This is, when we talk about creating value, it's not just about exit strategies and getting a top dollar for your company and that sort of thing. Even if you never sell, you can create a legacy like that, true value in your company and true value in your community. That's awesome. So thanks for pointing out, Jeff, that, great businesses, they don't happen by accident. They're built with intention. I love everything that you're saying. And so I would tell the audience, if you would like to connect with Jeff a little bit more about this, or 3PG Advisors, you can go to their website, 3pgadvisors.com. Jeff is actually, we're going to be together here in another week or two. We're going to be at the Lawn and Landscape Magazine Technology Conference in Las Vegas, Nevada, which is on the 23rd to 25th of 2005. If you bump into us, say hello, introduce yourself, ask us questions, whatever you want. If you'd like to learn a little bit more about landscape leadership, you can do that on our website, landscapeleadership.com. If you want to figure out ways to have your marketing make your company more valuable, there's tons of great advice on there. We're both on LinkedIn, like Jeff said. We're on social media. Connect with us there, ask us questions. And most importantly, if you've loved this episode and it's really been helpful to you, or you think one of your peers would be helpful, make sure you share this episode or share the social posts you might be seeing. And if you love this show where we talk about in-depth topics like this, go ahead and hit the subscribe button on whatever platform that you're listening on. So thanks so much, Jeff. Thank you again for being so gracious and appearing on the podcast today. Really appreciate you being here.
Yeah, thanks for having me. I'll see you in a week. Look forward to it in Vegas.
All right. Thanks everybody.
Jeff. Take care.